It's construction day on Apartment Market Dynamics, our homage to the big return of development in the apartment industry. In our last episode, we gave you the stats from first quarter 2013 on how the U.S. apartment market is doing. We told you how rent growth levels are easing across the country. And today, we're going to focus in on one of the key factors that is driving down rent growth levels. And with that, welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons, and I'm joined by the Bob Vila of the multifamily sector, Greg Willett. So, Greg, why don't you give us kind of a recap of the stats we talked about from construction in the last episode?
Let's go through those numbers, talking about the 270,000 or so units that are under construction in the U.S. right now. We've got a chart for you again. The exact number is 270,263 units under construction in the nation's top 100 metros. That's roughly in line with the long-term norm that was seen during the decade or so from the late 1990s through 2008. Furthermore, in the big picture, it doesn't look like more product on the way than the nation can handle. But when you're talking about product under construction, what really matters is getting the right properties in the right locations. And that right locations part is what we'll really talk about today. Obviously, we're more aggressive in some metros than in others, so let's run through that list of where we see lots of building activity occurring. And Jay, you're going to start us off with the most active big markets.
Yeah, let's talk about those active markets. We're going to show you the markets that have the biggest inventory growth. So this is new supply or construction, I should say, relative to the size of the market. And on top of this first list, Austin, Texas, and by a big margin, 12,690 units underway, and that translates to 6.8% inventory growth just over the next year and a half or so. Raleigh-Durham is number 2. Projects under construction there are going to grow the inventory base 5.9%, and that pair probably doesn't surprise many folks. Those have been two of the markets that lots of people have been high on, even going back during the recession, and so construction got going there very quickly. Maybe a little more surprising on this list, the next two markets, Charlotte, where 5.7% near-term inventory growth is just a hair behind nearby Raleigh-Durham, and then Denver-Boulder, where the growth rate over the next year and a half or so will reach 4.4%. And both Charlotte and Denver were a little slow coming out of the gate in terms of new construction getting underway, but they've had lots and lots and lots of new starts taking place over the past few quarters or so as apartment fundamentals there have been very, very solid. And going back to places where development started very early, San Jose is on track for 4.3% inventory growth, and Washington, D.C. on pace for 3.7% growth. And something to note when we talk about all these markets, for most of them, the construction activity is very widespread, but there is one meaningful exception, that is San Jose. In that market, the construction is by and large very concentrated in the North San Jose Milpitas submarket.
Jay, let me pick up the list from there, and we'll go to one that everybody knew would be on the list here, and that is Dallas-Fort Worth. Dallas-Fort Worth is about to get 3.5% inventory growth. Under construction right now, 22,837 units. That's the biggest unit count in any particular place across the country, though DFW doesn't quite reach the top of the charts in terms of inventory growth because it is such a big metro. Also at 3.5%, and maybe this one's a little bit of a surprise to see on the list, it is West Palm Beach, where 2,795 apartments are under construction. Again, maybe a little bit surprising, but you can actually justify some construction getting underway in West Palm Beach at this point. It's an area that's shown considerable momentum in terms of occupancy improving of late, and it's actually a top 10 performer nationally for annual rent growth. Next on the list, and here's the real shocker of every market that we're going to talk about today, it's Jacksonville with 3,067 units under construction, 3.4% inventory growth. That just sounds nuts for a place where the overall occupancy rate is among the weakest nationally. It's just 91.5%, and pricing is still more than 6% below pre-recession levels. The one good thing you can say about getting some product underway in Jacksonville is that pretty much all of it is clustered around the St. John's Town Center Mall. It's a nice area of town. It is performing better than the metro overall, but still, this is a lot of product for a market that's still pretty far from overall recovery. And then finishing this list of big markets that are going to have at least 3% inventory growth over the next year and a half or so, we have Nashville, 3,623 units, 3.3% inventory growth. Also 3.3% inventory growth in Seattle, where 10,789 units are under construction. And then finally, we've got San Antonio, 3% inventory growth right ahead, 4,811 units under construction.
Now let's talk about a few markets that you might have expected to be on those lists but didn't quite make it, even though the absolute number of units underway is very big. Houston is on pace to add 13,129 units, and that's a bunch, but the corresponding inventory growth totals just 2.2%. I think that one is a little bit surprising to see Houston ranking so far below the other major Texas markets, despite the strong economy there and the lack of barrier to entry for development in that market, and that reflects that there's still very little development occurring in the suburbs, but lots and lots in the urban core. Elsewhere, Los Angeles has 12,232 units underway for 1.2% inventory growth, while New York's ongoing construction tally is 16,054 units, and that equates to just 0.8% growth in that stock.
Jay will finish it up with one more list. This would be small markets. We've talked about the big markets that have at least 100,000 units in their inventory. We have a handful of pretty small markets where you're going to see inventory growth of 3% or better in the near term. Certainly the one that stands out on this list is Charleston, and we have talked about in the past that this one has quite a bit of activity going. 2,033 units under construction in Charleston at this point, 5.1% inventory growth just ahead. And then we have a group of markets that have 3 to 4% inventory growth on the way. At 3.8%, we see Salt Lake City, 3.6%, the Bridgeport, Stamford, Norwalk area of Connecticut. And then we wrap this list up with Des Moines, Iowa at 3% inventory growth, and also 3% inventory growth on the way for Little Rock, Arkansas.
And one thing that's important to point out, talking about all of these markets, is that when we say that there's a lot of construction occurring in these areas, we're not necessarily saying that they are overbuilding. In fact, we are predicting fairly stable occupancy rates in most of them, given that for the vast majority of these metros, they fall in one of two categories. Number one, these are job growth leaders, so they're expected to continue to register strong housing demand, so that should continue to keep occupancy in good shape even with some new supply. And others of these markets are areas that are just chronically understocked with apartments, and so they need some more supply to catch up with demand. However, of course, there is lots and lots of new supply moving through lease-up, and that does tend to put some limits on rent growth potential. Quite a few of them could be challenged in that regard over the next couple of years, especially in some of these individual submarkets where apartment development is highly concentrated. So that wraps us up for our special on construction. So until next time, for Greg Willett and for MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.